Hi, my name is Joern from Norway. I'm an Inner Circle member here at Binary Options Experts, and this is my understanding of the trade plans. First of all, Binary Options Experts has developed a trade plan checklist for us members to follow when trading binary options. They have gone above and above to make this as simple as possible. We only use two different moving averages, the 3 moving average and the 7 moving average. So, where do we start looking for potential setups looking at the market? Well, BOE provides us with daily market analysis, which include put zones and call zones for each assets we can trade. Pay attention to the word zone. These zones are areas where the market might bounce off and move into the opposite direction based on how the market has moved in the past, aka longer term resistance and support. Okay, I'll do my best to explain how I understand the trade plans, so let's begin. First of all, we need to determine when we need to look for a potential setup. What's the first thing that needs to happen? And as an example here, on the left side we are in the call zone, the green line under here. The 3 moving average is right here with the arrows, and you can see there is a green bar that is crossing the 3 moving average when the price is close to the call zone. As I said previously, it's just a zone, so it needs to be close to it. It doesn't need to break it, but it needs to be close. That's the first thing that needs to happen before we look at the potential call setup. On the right side, you can see there is a put zone and the 3 moving average as well. So it's just the opposite of what I said. We need a red candle to cross the 3 moving average when the price is close to the put zone. Again, it's just a zone, so it doesn't need to break it, but it needs to be close. As you can see here, it crosses the 3 moving average. That's when we go through our trading checklist that I will explain further. So, what does longer term resistance and support actually means? As I mentioned earlier, these trade zones are already longer term resistance and support areas where the market might bounce off and move in the opposite direction, right? On my screen right now you can see this red line here. This is the put zone on this particular currency, Australian dollar, US dollar. And on the bottom here we can see the green line, that is a call zone on this currency. Rule number 1A, it's part of my personal pre-preparation before I look at the market when it's live, or should I say when the indexes opens at the best times to trade. Right now it's about 1 hour before the market or the indexes opens. So this is when I do my pre-preparation, and I need to determine if there are other longer term resistance or support areas where the trade might bounce off. That would mean that it could go against us in the direction we want the trade to go. So I prefer to look at the 1 hour chart first. Let me go over there. This is the 1 hour chart. I also prefer to change between candle bars and lines and use both of them. Right now I will change it to line chart. Again, the put zones and the call zones are longer term resistance and support areas in itself. You can see it clearly here, why the put zone is there, why this call zone is here, this call zone, etc, etc. But I want to look for other longer term resistance or support areas between those lines, right? So I have put on this line here on the 1 hour chart. This is a big bounce from the upside. This is also a big bounce from the upside, and there's a couple of small bounces from the downside. If I change it to candlesticks again, you can see also there is a bounce off from below on this line as well, and this one from above, from below and above again. That I consider longer term resistance or support. It depends on where the price is, right? If it turns into support or resistance. This is one example that I put up and I use in my pre-preparation. So let's pretend that the price is down here on this second call zone, right? We can see a green candle crossing the 3 moving average, and we are looking for higher probability trades. But we have this longer term resistance area in this case right here, and if the price is around this call zone, you can see it's only about 7 pips. For me, that is not enough for a trade to develop. We trade between, well, let's say 15 minutes and 35 minute trades, and 7 pips is not enough for this price, because it can bounce off this area, right, like we have determined, and move back down and not in the direction we want the trade to go. That means a loss. So in this case I would rather stay away and protect my capital. So that is short how I look at rule number 1A, longer term resistance and support. I of course look for other areas between the call zone and the put zones where the market could go against us and bounce off. What is congestion? Well, simply put, in my opinion, it's a sideways movement in the market. It's where the price can't decide which direction to go. It just goes sideways. As you can see here on the blue boxes I have highlighted here, you can clearly see that the market is going sideways, right? This way, and at the bottom here and at the top here. In BOE we always say that we trade with the trend. The trend is our friend, so if the market is going down and is in a downtrend, we look for potential put trades, and if the market is in an uptrend, we look for potential call trades, right? But rule number 1B says prices should not be or are not in congestion. We don't want to look for potential setups when the market is going sideways, like you can see here in the blue boxes, because we don't know which direction the market is going to go. Again, that is gambling, and we only trade the higher probability trades that we can have, right? So this is simply put my take on what is congestion. Sideways market. As you can see here, we had a downtrend here, a big move down, and usually when we see a big move, it usually goes into congestion or sideways. We don't know which direction it's going, right? It did, however, continuing down to this area here. A big move down again, then we have congestion, sideways movement. Don't know which direction it's going to go, but after that it goes up, right, in an uptrend. Big move up, then it goes into congestion again, sideways movement again. So that's my take on congestion. We don't trade when the price is in congestion. Overextended price, for me that means well, unusual movement in the market. You can usually see candle that is much bigger than the average candle sizes on that particular currency or assets. If you can see on this blue box I have highlighted here, you can see this big candle here. It stands out, right? It's much bigger than the average sizes of the rest of the candles here. Simply put, that is overextended price, and we don't want to trade when the market is looking like that with a big candle like this. It's common to see a price movement like this at the start of a session, because that's when all the indexes opens. And well, I'm not an expert, but simply put, when I see a candle like this, especially at the start of a session, I just wait for the market to be a bit normal, as you can say, to look for potential setups. This is a price that is overextended. Then we stay out. We just wait. We practice pillar 3. Why do we say that the prices are not near previous day high or low? Well, it's because the highest price on the previous day and the lowest price on the previous day can turn into strong support and resistance areas. So the price can bounce off these areas, and we want to stay away from the market if the price is close to these two areas. To find those previous day high and lows, we need to go to the daily chart, day 1 up here, and we look for the previous candle that we are in right now. So this all the way to the right, this is today, and we need to look for the next candle there. That's the previous day. So I have marked up here with those yellow dotted lines. This is the previous day high. You can see this arrow here, and this is the previous day low. So if we are in the market on the 5-minute chart and looking for potential setups, regardless if it's in the put zone or the call zone, if the price is near this area here, and for example our price is below this area here with just a few pips, it's a higher probability that this price will bounce off this previous day low and bounce back down. Same with the high as well. So if it's that's the reason why it says prices are not near previous day high and low. They can turn into strong support and resistance areas. Simply put. This rule says check for reports and announcements. You will always hear here in BOE that we don't trade the news, right? But when should we stop trading before an announcement, and how long should we wait to start looking at the market again after an announcement? My take on that is, first of all, before I do anything else, looking at the market, do my pre-preparation, I check forexfactory.com for reports and announcement that is scheduled for this session. I will be looking at the market. And also a very important thing is that I look for the market update from Joern in the BOE Facebook group, because we have Joern here that have over 20 years experience with trading, and he knows his stuff, so I check both of them. We also have heard that we should stay away from red announcements, but sometimes we will see in the market update from Joern that he says that some indices and currencies may be affected, even though it's, for example, a orange announcement or a yellow announcement. If Joern says in the market update that we should take that in consideration, if it's regardless if it's a red, orange or a yellow announcement, I personally stay away from that currency or assets around that area, around that time. As you can see here as an example, on Tuesday 9th of August, that's today, he says monetary policy meeting minutes out of Australia at 1:30 GMT will impact the Australian dollar US dollar it cross rates and the ASX 200 index at announcement time. You can also see on the left side here on the Forex Factory that 1:30 a.m. or GMT time, it's a red announcement, right? So today we don't have any other announcement that we should be aware of other than this red one. But as I said, sometimes Dwayne puts in the market update about orange announcement and yellow announcement. I always stay away. So how long before an announcement should we stop trading? I always don't have any expiry trades less than 30 minutes before an announcement. So for example, in this particular Australian announcement, it says 1:30. I don't have my expiry time on a potential setup later than 1 GMT. That's half an hour before the announcement is scheduled. That's because we can often see that announcement could affect the currencies or the indexes just a few minutes before the announcement is actually out. And that could take us out of a potential good trade. So I always stop at the expiry time half an hour before the announcement. So how about after announcements had occurred? And that's not an easy question to answer because well, I like to keep things simple. So I always say stay away from the market until the market has settled down, when you can see some normal activity in the market after an announcement. So it can be half an hour, 45 minutes, maybe an hour as well. You just need to be a student of the market and see if it's normal activity again in the markets. That's my take on that. When it comes to weekends and holidays, and I usually say bank holidays, there is low volume into the market and we need to stay out. And the reason for that is when there is or are bank holidays throughout the world, there will be lower volume into the market. The banks are closed, not many people trading the currencies and assets. And to be successful in binary options trading, we need the volume into the market. And if there's lower volume into the market, there's not higher probability that we will be successful with binary options trading. So simply put, if there are weekends or holidays and bank holidays, you just stay out of the market. My take on if the price activity is true or false is that when the price activity is true, for me it's normal activity in the market. The sizes of the candles or the average size of the candles are the same almost. It looks normal in the market. When it comes to false price activity, I want to try to show you an example right here because as you might remember previously, I told you about 1:30 GMT Australian dollar announcement that was coming out. So right now the announcement should be out for about 30 seconds ago. You can see the price is starting to move a bit unusual than it normally does. And that means false price activity in my opinion. You can also see on the left side here where I have these yellow arrows. You can see this big spike here as well. Most likely this occurred when there was an announcement earlier on, because there are unstable conditions in the market. The market doesn't know which way it's going to go. And you can see it's so big candle compared to the other ones, and that is false price activity in my opinion. And of course we stay out when the market is acting unnormal. You can see here that the announcement I was talking about, that was just out. It didn't seem like it had that much effect, but you never know. It could have a couple of minutes delay, for example, in the market. We always stay away when there are announcements and false price activity. So what is all this talk about rule number 2 about, eh? Well, it's actually about where we enter the market if every rule in 1A to 1G is a go. We only need one of rule 2, that's 2A to 2D, to be met to have a go signal. So in this example I will use a call setup to show you and try to explain it as simple as possible, okay? This is rule number 2 if you are looking for a buy signal. If you are in the call zone and we have a green candle crossing the 3 moving average and all the rules or the checklist from 1A to 1G is met, we only need to know when to enter the market, right? So we will talk about a bit rule number 2A first, but I want everybody to pay attention to all the 3 others here. Rule number 2B, 2C and 2D. As you can see here, all the 3 moving average and the 7 moving average is pointing up at the same time, regardless of how it looks here, right? If it has crossed or not, and if it's above or under. Just keep in mind that the 3 moving average and the 7 moving average is pointing up in the same direction we want the market to go. So let me try to explain rule number 2A. Again, we only need one of these rules to be met to have a buy signal. On this screenshot, look at where I have put the entry arrow, the yellow one. That is an entry. But why is it an entry? We have the call zone here, it's the green line right here. And all the way to the right, it says primary indicator, that's the 3 moving average by the way, is higher than either of the previous 2 swing lows. And if you look at in the middle of the screen here, it says previous swing low on the primary indicator, 3 moving average. So we have a swing low here in the middle, and the next one that happens when we have this buy signal is higher than the previous one. That's rule number 1A. That's an entry and that's a buy signal for us. It's higher than the previous one. Simple as that. So let's move back to our chart here. Rule number 2. Remember I said look here on all the 3 at the bottom here. All 3 moving average is pointing up and the 7 moving average is pointing up. Let me try to explain that in a screenshot right here. You can see here the 3 moving average is pointing up, and at the same time the 7 moving average is pointing up, and we are in or close to the call zone. We have a green candle crossing the 3 moving average, but we didn't meet rule number 2A because it's not higher than the previous one, so we need to look for one of the other rules, right? But remember what I said, look for the 7 moving average to point up at the same time when the 3 moving average is pointing up. That's a buy signal. So here you can see, again, everybody is pointing up at the same time. So I hope I explained that as simple as possible, and that's my take on that.